Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you could better understand not only what we see in the global landscape, but also what we are currently in, how we're positioned, and also any important changes we may be making. Well, you know, the month ended, and we look at our relative strength rankings, of course, every single day. We look at all of our client positions across the board every single day and throughout the day. And we look at what's going on in the real world. I can tell you this, the real world, generally speaking, emerging markets continue to chug along and do a little better. The U.S. economy is slowly getting just, again, a little bit better. We had a lot of information come out, not only from Ben Bernanke yesterday, that basically talked about quantitative easing and what they're doing and how they're going to continue their asset purchase program. And they actually may even look at expanding that if need be. What that ultimately tells you is the Federal Reserve is behind moving the economy in the right direction. They also talked about our politicians and how they need to get their act together to further stimulate the economy. Now, obviously, Ben Bernanke can only do so much. Our government officials need to do a little bit more and a better job of it. We look across the pond now at Europe, and we look at France. We look at the various enterprises and the central banks in other countries. And what we're effectively finding is that they are also putting a little bit more gas on the pedal in order to stimulate their economies. We saw a nice rally this morning after yesterday's sell-off. And again, the sell-off yesterday was somewhere in the magnitude of 1.25%, nothing big. And most of that loss yesterday was regained, of course, today after some of the announcements. I firmly believe that we're going to continue to see small, mid-cap, and large-cap in the U.S., which seems to be the predominant player, and the equity markets continue to outperform for some time. We're going to watch our rankings. Of course, we will making adjustments accordingly. We also see the small cap, and now we're starting to see just a little bit of inkling in the large cap emerging markets starting to get just a little bit relatively stronger. While we own small cap in our portfolio on the emerging market side, we don't own large cap. And of course, our positions can change at any time, but we're watching the large caps closely because they're starting to gain just a little bit of steam. So maybe what that means is the big underperformance the emerging markets have had the last 3-4 months, and actually over the last 3.5 years, may be coming to an end, and that may be one of the asset categories that gets added back in our global tactical portfolio when it's appropriate and when it's relatively strong enough in order to gain some more outperformance. We continue to like our income areas. Of course, we are shunning or staying away from muni bonds, large bond mutual funds, and corporate bonds and treasuries. Anything long or intermediate term we're staying away from, and I firmly believe investors need to understand that most of these long dated, intermediate dated bonds, traditional bonds or bond funds, are really suffering year to date. Other areas of fixed income are actually doing quite well. The preferreds we own, our emerging market bonds that we own, our high yield bonds across the pond in the emerging market economies, our mortgage-backed REITs continue to do well, along with our oil royalty trusts. So we're in different areas of income, not traditional bonds like most people would believe or invest in, but ultimately there's other areas to invest. Our clients are doing quite well year to date. Our global tactical portfolios are on track. I firmly believe as the economy continues to get better, we will continue to be in those relatively stronger areas. As we've always taught our clients, relatively weak assets give negative returns and underperformance. Relatively stronger assets, rotating into those, are a much better solution than staying in a buy and hold pattern. If you're a client and you have a question about your portfolio, give us a call. If you're not a client and want to become a client because you want to realize the benefits of active management, which includes risk management, call my firm for a consultation. There is a big difference. We invite you to experience it. I hope everybody has a safe and happy week. And again, if you're not a client, please call us for a consultation. You'll be glad you did. Have a great day.